Better System Trader, Episode 19.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 19 and I'm your host, Andrew Swanscott. On the show this week, we have father and son trading team Jake and Elliott Bernstein from 2chimps.net. Jake, who's already been a guest on episode 1 of the podcast, is an internationally recognized futures analyst, trader and author who's pioneered numerous technical, cyclical and seasonal methodologies. He's written more than 41 books, has appeared frequently on radio and television and also lectures extensively throughout the US, Canada, Europe and Asia. Elliott has over 15 years of market experience with a strong focus on emerging sectors, China and APAC region, equities and technical trading methods. With 2 books and dozens of articles on related topics, he specializes in clear and easy-to-read analysis of timely market questions. Elliott has traveled and lived abroad extensively, and with nearly a decade spent between Beijing and Shanghai, he is fluent in Mandarin Chinese. In this week's episode, we discuss rotational optimization, timing triggers, the incorrect use of indicators, the 3 components you must have in a trading strategy, and the Chinese markets. So let's get to it. I hope you enjoy the chat with Jake and Elliott today. Hi, Jake and Elliott. Thanks for joining us today.
Pleasure to be here, Andrew.
Thanks for having us, Andrew.
Cheers. Well, Jake, many people will already know you, know your background, but for those who don't, could you please just give us a little bit of a quick overview into your background in trading?
Andrew, I started trading in the summer of 1967, which, if you do the quick math, makes me a little bit on the old side. I started trading stocks, then graduated into futures a few years later. I've written 45 books on trading. I've done webinars, seminars all over the world. I trade practically every day, not day trades specifically, but short-term trades. I use strictly technical methods, seasonality, and specific chart patterns. I go for high probability and I have a specific profit maximizing strategy. And that's probably all that's necessary to know about me, except that I love my work and I do it every day.
Sure. Excellent. Thanks, Jake. And Elliott, how about you? Can you give us a little bit of background into how you got into trading?
Sure. Well, it wasn't hard to get into trading with Jake as my dad. It was the late 90s. I had been learning about stocks for quite a few years before that, but I started trading in the late 90s. And it was actually pretty easy at that time, considering the market conditions and the what turned out to be the tech bubble. So that was a fun and interesting introduction. And I never, despite those experiences and some of them being pretty hard, I never quite lost interest in technology. And I still focus a lot of my own trading on technology and emerging sectors, which includes other up-and-coming things like various types of medicines and developing services that I believe could be important in the future. I use Jake's methods and I develop my own based on the basis of those. So it's all technical trading. It's all based on, as he said, chart patterns and seasonality and things of that nature. Trade almost every day as well, just like him, and hopefully we can talk a little bit about that later.
Yeah, sure. So it must have been great to have a trading mentor or trading partner so readily available with your dad there. How has that had an impact on your trading?
Oh, it's had a huge impact on my trading. I think that actually there was a period of time where I wanted to try anything and everything, and really came to the conclusion through trial and error that these methods are solid. The technical trading methods that he and I work on together, they've just been really formative in my understanding of the markets. And that's what I really like about it, is that, as he'll talk about as well, these are 100% objective methods. And so since I have studied them and I know what they're all about, he and I can look at the same chart with the same indicators and come to exactly the same conclusions. So, Andrew, you asked about how trading together works for us. And it's very funny because a lot of the times we don't even have to talk about the trades that we do. We're doing the same trades anyway.
The other day, for example, Andrew, I told Elliott that I bought Biogen down $85 a share, had not known that even though his desk is just not too many feet away from me, that he had done the same thing. So we both were kind of surprised.
Mm-hmm.
Oh, that's really cool. So a question for you, Jake, for all the dads out there, how did you actually go about introducing Elliott into trading?
It was very important for me not to push him. So I wanted him to get an interest in what I was doing. When he asked, I showed him, but I didn't want to push him after that. Elliott then decided to pursue his own career in Mandarin and in China, moved there, started his own business there. We didn't really talk about trading too much, and then just recently he came back and he's back trading with me again. But I think when it comes to children, of which I have 3, I've never wanted to push them to anything because that would not be a good thing for them.
Okay. And do you find it difficult to work with each other?
Not at all, no. We have a great time bouncing ideas back and forth. Jake has given me a lot of free rein to develop the Two Chimps website that I run, mostly as far as the design and the elements are concerned, but we're still very much in collaboration on the methodologies and the basic ideas that go into the content.
Yeah, it's been fairly easy working with Elliott, and I enjoy it. I think it's every father's dream to have his son go into a good business or to go into his own business with him. I didn't want to go into my father's. I grew up very poor. My father was a tailor. He didn't want me to be a tailor, so I didn't go into his business. But to have Elliott voluntarily do what I'm doing is quite exciting for me.
Yeah, that's great. So there's some great advice there. My oldest child is only 3 years old, so I've got a little while yet. But thanks.
Your troubles are not even starting yet.
Yeah, that's right. One other question, Elliott. How have you used what Jake has taught you to pick out your own particular style or approaches?
Well, my application of Jake's methods, it's actually pretty straightforward. Jake's work for a long time, and for the most part, is focused on futures and forex and those types of markets. And my application of it has been very much related to stocks, ETFs. We're getting into some option strategies a little bit with that as well. So it's the other side of it. It's a little more accessible for a broader audience.
Yeah, right. Okay. So I think we'd just like to move on to system development now because you've developed a lot of different trading strategies. So where do you find these trading ideas?
Sometimes after having too much to drink. There are a lot of things that we read in books, and you ask yourself the question, does this really work? It seems to have validity on the surface. It sounds like it should work, but then when you take it to the computer, you find out it doesn't work. And so testing different ideas, testing things that we hear about, take them to the computer, test them. And for every 200 or 300 things that I test, maybe 1 or 2 things work. So the ideas come from anywhere and everywhere. So I've had some wonderful ideas sitting on an airplane. That's how I developed the momentum divergence method, thinking about the way that an airplane takes off and how it uses less fuel when it's coasting and so forth. And so it's all these ideas come from many different places, but most of them turn out to be dead ends. So as Einstein said, research is what I'm doing when I don't know what I'm doing.
Yeah, Andrew, and if I could add to that, a good example is this Golden Cross and Death Cross thing that you hear about on CNBC and elsewhere all the time. And I sat down the other day and programmed a version of that into Genesis. And, of course, as you'd expect, it came up with pretty abysmal results. But the point is that a lot of the ideas that Jake and I have as the basis one of these technical indicators, or a set of technical indicators as people try to apply them normally. What we do is we refine those ideas because we think a lot of times at their base, they have something, they're on to something. It just hasn't been refined to the point that it's actually useful or has good predictive value.
That's interesting. So can you explain your process around testing indicators or finding indicators that actually work?
Well, the first thing we do is we find an indicator. We determine if it can be programmed. If something can't be programmed, we can't use it. Once we have the code written, which is usually very easy to do, we take it to a bunch of data, usually 10 or 15 years of data. We leave out of the sample the last 2 or 3 years. So we develop the process on data over the last 10 years, but not looking at the last 2 or 3 years. We use a setup trigger follow-through method. So the indicator is a setup. We need a setup to trigger. Right now, for example, we're working with the inside bar, a price bar that trades all entirely within the previous day's range. That is a setup for a change in direction, but we need a specific trigger for that direction, that trigger being closing above the high of the first day or below the low of the first day. So all of those can be programmed into the computer. We then build in a profit target and a stop loss, and we optimize the procedure looking at the best combinations. Once we have the best combinations, we add in the data the computer hasn't seen out of sample data and see if it works. Most of the time it won't work, so we go back to the drawing board and find out what we did wrong. And that's the process in a nutshell.
Okay, so we might come back to that setup trigger follow-through method a little bit later, but you mentioned optimizing. So there's a lot of ideas about how to optimize and people following certain approaches to optimize without over-optimizing. So how do you do it?
We do it in the largest way possible, which, I mean, we don't look at small increments of indicators, we look at large increments. Example, people will optimize a stop loss and they'll say, what is the best stop loss for this methodology? And they will optimize, look at every dollar of stop loss. So determine $1,000, 1,001, 1,002, 1,003, and they'll look at all of those. I will only look at increments of $100 in stop loss, 1,000, 1,100, 1,200, 1,300, and so forth. I will not optimize more than 4 variables at one time. I will not optimize many variables at the same time so that I don't get a curve fit, because the real danger in optimization is curve fitting. And of course, if you fit the curve, in other words, if you develop a curve fitted system, it will not go forward. Therefore, the only alternative is to develop it on the entire data, in which case it looks wonderful but performs terribly. So the idea is large steps, not too many variables, not too many inputs, keep it simple as you possibly can, and you will get results that go forward. We have some systems that we developed about 10 years ago that are still performing well today without any additional optimization.
Yes, I think I noticed, perhaps it was on your blog, Jake, you mentioned a concept called rotational optimizing or rotational optimization method. What do you mean by that?
That is where you start with the greatest inputs. In other words, start with the 2 basic inputs. What will trigger a long, what will trigger a short? Then, after that's been optimized, you go in and you optimize a profit target. Then after their profit target, you optimize the stop. So you rotate the process instead of optimizing all variables at once. What most people want to do, Andrew, is optimize all variables at the same time and go through maybe 2 or 3 million tests. They will always find something that works if they do that, but it will not go forward. And that's the key issue. We need to look at out-of-sample data. We also look at data from the past. So in other words, we'll optimize on data, let's say from 2000 to 2010. Then we'll see if it goes forward. And then we'll also look at data from 1998 to 2000 to see if it goes backwards as well. Then we know we've got something that will last.
And when you're optimizing, what metrics are you using to evaluate or compare strategy results?
We look at average profit, average loss, percent win. We look at number of days in long trades, number of days in short trades, and the most important for me, maximum consecutive winning trades, maximum consecutive losing trades. We don't like to see more than 6 consecutive losing trades. We would much prefer 3 or 4 consecutive losing trades in the entire history, because it's the consecutive losing trades that causes people to break their discipline.
Mm-hmm.
Yeah. Did you want to add anything further, Elliott?
Oh no, I just think that it's an important element of psychology that a lot of people don't take into account when developing or using systems. It's unrealistic to believe that somebody might continue to use a system that allows them to lose 4 times, 5 times in a row. It's only, you could say, it's an extremely disciplined or an extremely dumb trader who might continue to do something even if they've lost that many times in a row.
The nature of psychology in markets is very simple. Most people are able to lose 1 time and say, I understand, it's part of the game. They lose 2 times, they're still okay. They lose 3 times in a row, they're beginning to think, what am I doing wrong? How can we change it? They lose 4 times in a row and they're ready to throw in the towel. We know from extensive system testing that even the absolute best systems will lose 6 times in a row or more. So if you're not prepared for that, it's not a good idea to take that particular system.
Okay, so you mentioned optimizing targets and stops, and on your website you often refer to profit maximizing strategies. So can you give some examples perhaps of what you mean by that, or some suggestions for traders to test themselves?
Certainly, we like to trade in units of 3, Andrew. Not that it's a fancy or Fibonacci number, we just like to trade in units of 3. Unit number 1, we liquidate at a profit target in order to get out of danger. So once we're out of danger, by which I mean as soon as we hit our first target, we have no further significant risk. Our stop loss goes to break even. Our second trade goes to a second profit target, which depends on the nature of the system. Once we reach our second profit target, we keep our third position with a stop at break even and give the market plenty of room, because even though we will be stopped out of that third position at break even 70 or 80% of the time, the 30% of the time that we're not stopped out is where the really big money is. So it would not be unusual for some of those trades to run 2 or 3 months or longer, as opposed to the first profit target, which may only be hit 1 day later.
Okay, so does that type of strategy only apply to trend following?
No, it applies to any system that we trade, but we're really not trend followers. We're more breakout traders. We prefer to buy breakouts to the upside, sell breakouts to the downside. The only trend following systems that we use, if you can consider them trend following, are buying support, selling resistance, or seasonality, where we're only trying to take a piece of a move that's already in process.
And what about stop methods? So how do you identify and evaluate the different types of stops that you could use?
Stop has to be specific to the volatility of the market, and we much prefer percentage stops as opposed to dollar stops. So if you have a percent stop, it will adjust to any market condition. If prices are higher, then percentage stop will mean that your dollar risk is higher. When volatility is lower, your dollar risk will be lower. And so the stop is an integral part of the system. The thing that always amazes me is people will say, they'll call me up, they'll say, Jake, I bought the gold market. Oh, you bought the gold. Why did you do that? Well, I think it's going to go up. What's your risk? $500. Why are you risking $500? Well, it's the only amount of money I can afford to risk. My response to that is, I don't think the market cares how much you can risk.
Yeah.
If you're risking $500 on a market that has a $1,500 trading range in 1 day, you're going to lose every time.
Okay, if we can just jump back to the setup, trigger, follow through method that you mentioned earlier, can you just clarify the difference between the three of those?
A setup is a pattern. People say, well, a reversal or a key reversal works. We don't know if it works. If we test it just by itself and ask the question, does it have predictive value? The answer is no. So it's a pattern. That pattern must have a trigger. The trigger says, if you see this pattern, then take action if the following thing happens. That increases the probability in some cases to 85 or 90%. The follow-through consists of 2 parts. The profit target, which most people are not familiar with because they're only interested in wondering how much they're going to lose. So you need to know your profit target and your stop loss and your profit maximizing strategy. All of those constitute the last part of the equation. So every system we use, every method we use must have all 3 elements. I would respectfully submit that anyone who trades who doesn't have a setup, trigger, follow-through idea of what they're doing will lose money sooner or later, most likely sooner.
They can't be used on their own?
Well, sure they can. They can be used on their own, but they don't constitute part of an entire system. In other words, I might say, well, this is a head and shoulders top. Well, isn't that wonderful? What comes next? Well, I need to be a seller if it's a head and shoulders top, in which case I need to know where I want to sell. Once I know where I want to sell, I need to know how much I'm going to risk. So they have to go together. Otherwise, it would be like driving in an automobile without any brakes. Yes, my automobile is doing just fine. Now I need to come to a stop sign. What do? I have no brakes.
Yeah, sure. Now, there's a lot of mention on your website about timing triggers. Can you explain what that is?
Timing trigger, for example, if we're talking about the euro currency system, one of our best systems. It looks at the relationship between what happens in the European currency versus the US dollar on Thursday versus Friday. We know that if the euro closes lower than it opens on Thursday, and it trades below Thursday's low on Friday, that would be a timing trigger that would get us into that trade. If it does not trade below Thursday's low on Friday, there is no trade. No trigger equals no trade. Conversely, if the euro closes higher than where it opens on the futures on Thursday, then we buy Friday above Thursday's high. That would be our timing trigger.
Okay. I just wanted to jump back, actually, sorry, to a question on markets and timeframes. Once you've got an idea that you're going to test, how do you determine the market or the timeframe that you'd select for that?
We try to avoid the intraday time frame. I have a number of trading systems that do well intraday, but we're not primarily day traders, and I don't advocate that for most people. It's bad for your health. So most of our testing is done on dailies. If we're looking for an investment type trade, we do weeklies. It's really not productive to do weekly systems on futures because they expire so quickly. So it's more functional on stocks where we can do weekly charts, weekly indicators, and get bigger moves over a longer period of time without having to switch contracts. So it's very much daily in futures, daily or weekly in stocks.
And another question for you, Jake. You've been trading for quite a while now. What changes in the markets have you noticed over that time?
Lower commissions, faster speed of execution, less cheating, more volatility, more opportunity, and more dumb traders.
What do you mean by less cheating?
Well, the concern always was that with the pit system in operation and the floor broker system in operation, floor brokers were stealing from the public, possibly putting on a trade on their own account and then selling it to the customer at a higher price. That has been a normal procedure for a long time, and people objected to that. That would also hold true in the shares market. So with electronic trading, there's virtually none of that. The price that you get is usually the price that you see, maybe a small difference, sometimes even better. So it's become more efficient, it's become faster, but none of those necessarily equate with more people making more money. The key consideration here is the availability of information. The good news, there's so much more information than there was many years ago. The bad news is most of it is worthless.
Yeah. And how do you think those changes over the years have impacted the style of trading that works today?
I think people are more interested in the instant moment. There's been a saying that we live in an age of instantism. And the faster that price executions have occurred and the lower that commissions have gone, the more people labor under the impression that they somehow can make money faster and easier. Unless you're a high-frequency trader with your server located next to the exchange, with the ability to trade millions of shares to make 1 or 2 pennies, it's not going to work. So even though I wrote 2 of the best-selling books on day trading, it's not something that I advocate for most people. The bigger the time frame, the better the trade. The bigger the time frame, the more the profit. The bigger the time frame, the more accurate the systems, up to a point.
Okay. And one of those other changes that you mentioned was volatility. So what do you think about the volatility in the markets today, and how do you think it will resolve?
It's absolutely hair-raising. I can't believe it. When I see some stocks down $50 or $60 a share simply on an earnings report or on a rumor, it's unbelievable. I think it's going to resolve at some point in the future where people are going to get burned so badly they'll decide, well, this is really not for me. But right now, it's the game, and the game continues as long as people think they can make money at it. And I would say also that many of the brokerage houses are responsible for that. They give you the impression that you can make money every day. They give you the impression that you can take $500 or $600 home every day, and that's, if you do that every day, it'll be just fine. It doesn't work that way. It's not like that at all. People just don't want to understand that because they're attracted to the lure of the idea that they can do this at home. It's their own business. It's the ultimate capitalist tool. It's really not.
Yeah, Andrew, and it really is the case these days that the kind of information and the kind of tools that the discount online brokers are offering to retail traders, it's just there are more of them than ever. And so more than ever before, it's information overload for people. They think they know how to use the tools, whether it's news or it's fundamentals or it's technical data. And that's why I think a lot of our methods are more important than ever, because they simplify in a lot of ways. They reduce the number of factors that any individual needs to look at in order to make decisions about trend, about various price breakouts and things like that, really helping to avoid this information overload that I think so many people are dealing with right now.
Andrew, here on television, on business television, there's an advertisement that runs and it says, if you open an account with us today, we will send you a trading strategy you can start using right away. Well, isn't that wonderful? What is that strategy? Does it work? What's it based on? What are the statistics? What's the track record? How much money do you need to trade it? Yes, you can start using it today. You can go kill yourself today. And we'll help you. He will help you, but you won't know how the system works and what it comes from. So it's absolutely ridiculous. And the thing that's really sad about it, Andrew, is people believe that nonsense.
Yeah. And I mean, it's great to have all these tools. It's wonderful to be able to get the information if you want it. But I think people need to remember that the brokerages only have their own interests in mind by giving you access to these tools. They're trying to make you trade more. They want to make you trade in a more frenetic and a more, just volatile manner. And that is their main interest.
But remember one more thing, Andrew, before I'm done. How do brokerage houses make their money? They really don't make their money on commissions. They make their money on small increments of buying and selling. So you buy a stock at 38.5 cents a share, $38 a share. You think it's $38, they're charging you $38.03. Mm-hmm. But most of their money is made on the float. In other words, money that's in accounts that's not being used. The customer rarely gets the interest earnings on those. So the reason many brokerage houses have not made enough money is because interest rates are so low, they're not getting very much earnings on the float. So they've had to come up with other inventive ideas to make money, like extra charges, non-activity charges, extra special fees for this and that and so forth. We've said enough, Andrew, before we get into trouble with the broker.
Yeah, sure. Okay. Maybe we'll switch topics, I think. So, Elliott, you've spent a lot of time in China. Mm-hmm. Do you trade or invest on the Chinese stock market?
I do some trading and investing with regards to Chinese stocks. But as I was saying earlier, Andrew, it's a little difficult for non-Chinese citizens to access the Chinese markets directly, unless you're a giant hedge fund or you're an institutional investor of some sort. Most Chinese shares have been inaccessible directly. So the way that I do it is through ADRs and ETFs and so forth.
Right, okay. And what about the characteristic of the Chinese stock markets?
Well, pretty schizophrenic and pretty lacking in trust. I think those are good ways to characterize overall what's been going on in the Chinese stock market. The major issue has to do with trust and belief in stability, and very few people over there have very much belief in stability. The giant run-up that we saw in the Shanghai Stock Exchange and the other exchanges in China over the past year or so came, in my opinion, from people who had previously been trying to make money in real estate, realizing that the market had just stopped. It had stopped growing, and that is really the result of government policy. They're trying to find a new venue for that and thought maybe the stock market could be it. Of course, that's not a great reason, at least in the short term, to put your money into the stock market. And as soon as the government started meddling in that market, as they had in the real estate market, it started to collapse. So it's kind of as simple as that.
Right, okay. What styles of trading strategies do you think lend themselves better to the Chinese markets?
I think you can still do the exact same styles of analysis that we use for our own systems. Technical trading works very well. I would say fundamental is a little bit more difficult. If you want to do some kind of looking at the Chinese balance sheets or various things like that, you're going to have a lot of trouble. Standards over there are quite different. Mm-hmm. There's a lot more collusion in the marketplace. There's a lot more insider trading. And rules overall are much less defined by the government and much less enforced by the financial regulating authorities. So really, when it comes down to it, actually, my opinion is that technical is the only way to go.
Andrew, Elliott and I were in Hong Kong how many months ago? Was it last September?
Yep.
doing a seminar there. We had a very large attendance, and the vast majority, well, I would say everyone who attended our seminar there for an entire day and an evening were interested primarily in technical analysis and applying our trading strategies to their markets, and it has worked out quite well.
Mm-hmm.
Okay. And do you have any suggestions for people who want to get involved in the Chinese stock market that are outside of China or Hong Kong?
Don't.
Wait. Yeah, now is not the time. I think we're going to see some really good levels sooner or later, and at that time, we'll be writing on our websites about how and when to get in.
You must remember, Andrew, that the biggest players in the Chinese market are what they call ChICOM, which is the Chinese Communist Party. They have been instrumental, especially in the last several weeks, of taking very large positions in the market with their currency, buying and selling the market, and many times creating chart patterns to look like certain things. And that is a known fact. So you need to be very careful because your competition will be the government. If you can figure out what they're doing, you'll be on the right side of the market.
Wow, that's really interesting. I never realized that took place.
Andrew, the fact is that if you consider the Chinese government to be one of the major players in the market, it's just like any other market. You can't outcompete the commercials. You can't outcompete the biggest players. They're always going to win in the end. So as a small trader, as we are, and as many of our customers are, the little guy, it's our position and it's our responsibility to sit on the sidelines and wait till we see a major trend reversal.
Yeah, okay, thanks. So, a couple of questions on trading research. So, what are you currently researching, or what areas of research do you think hold the most promise?
That's a difficult one to answer, Andrew, because we are usually doing so many things at one time. We've been researching inside bar patterns. We've been researching a little bit of artificial intelligence and price patterns, checking their predictive value. We always love seasonal trading for the seasonaltrader.com website. We like short-term trades. We're actually, for our Two Chimps website, we're using the standard things that I developed many years ago with some of the additions that Elliott's brought to it. So our point of view is if it's not broken, don't fix it. So as long as it continues to work, we continue to use it. And every now and then we'll find that needle in the haystack, but it takes time. So a number of things, primarily inside bar pattern, outside bar pattern, various types of momentum divergence, MACD divergence, and what we call detrended oscillator divergence is what we're working on.
So a lot of those strategies have been known for a long time.
Yeah. Mm-hmm.
They still work?
If you use them the right way, they work. But here's the problem. People don't understand them. They don't use them the right way. And the key, as going back to what we talked about just a little while ago, they are all setups. They need triggers. If you're not using the right trigger, the setup's not going to work.
When you say they don't understand them, are you talking about understanding the psychology behind what's driving it, or something else?
The way the indicators are constructed. If you say to someone, well, what's the difference between momentum and rate of change? They probably won't know the difference because there is no difference. People will look at their trading software and they'll say, oh, there's 114 indicators here. This is a wonderful thing. I'm going to use 43 of them, and we all agree I'm going to take a position. The fact of the matter is that almost all of those indicators are based on price, and unless you use a different time length for each one, they're all going to look the same. So that's part of the problem, is you need to understand what you're doing, not just because someone said do it. You have to test it or ask the question, where's the back test on this indicator? If there is none, it can't be used.
And what do you think the most valuable indicator is in trading?
In order of preference, for me, it's seasonality, which is absolutely flawless in terms of its history, by which I mean the history is there. There's no arguing with it. We know that it happens. We can prove it. It's unquestionable. We know the accuracy. We know everything we need to know. I would say second, momentum, the ability to spot momentum divergence and triggers. And third, I would say moving average channel, which is something that I developed about 25 years ago.
And what about you, Elliott?
Well, I just want to go back to the point that Jake was making about having all these tools and not understanding them. All of our work, no matter what tool that it uses, is focused on getting the definition down, to quantifying things, making sure that everybody is on the same page in terms of how they should be using these tools, whether it's momentum or a moving average or seasonality or a chart pattern, any of these things, they have to be defined. They have to be put into numbers. And if you can't do that, if you can't sit down and agree with someone else about how to program one of these indicators into a piece of software like Genesis, then it's not useful. It's not objective. And so a lot of our work comes down to just making sure that we know the terms of what we're working with. And from there, we can test it and we can decide whether or not those tools are useful for us.
Yeah, that's an excellent approach there, Elliott. Thanks for that advice. So I'd just like to wrap up with a couple of quick closing questions. Now, I know Jake's done this for episode 1 of the podcast when he was a guest, so maybe we'll get you to answer these, Elliott, if you don't mind.
Sure.
The first question is, what's the biggest lesson you've learned through trading?
Well, the biggest lesson that I've learned through trading is that you need to be disciplined. Like we were talking about earlier, some systems might be great systems if they throw you 5 or 6 losses in a row. One of the problems with not being disciplined is that as you progress through those 5 or 6 losses, you will become more emotional and your losses will get bigger and bigger. The 5th or the 6th one might wipe you out completely because you've lost all sense of how you should be approaching this. You've forgotten all of your other tools, all of your other points of discipline that you would have applied to those earlier losses. So that's one of the biggest lessons. That's one of the things that I try to apply to all parts of my life.
Sure. And what do you think is the hardest part about trading?
I mean, it's also taking those losses. I know it all goes back to this. I don't want to sound like a broken record,
yeah.
But if you take one, how do you feel? Do you go back and refine what you did, or do you start to get emotional? If you take 2, how do you continue to analyze that? And when do you go back and say, okay, I changed this the first time, but now this new problem just popped up. Jake, did you want to say something?
Yeah, I just wanted to say one thing. For me, Andrew, the hardest part is shutting out the noise, turning off the television, the business news, not listening to what anybody else is saying. And in terms of discipline, discipline comes from confidence. Confidence comes from making money. So if you're not making money, you're not having discipline because you're not having confidence. You're only making money if you have a trading system that works with rules that are clear. So it's one great big vicious circle where one thing impacts another, and the whole wheels will come off the vehicle if one of those pieces is missing.
Yeah, okay, thank you. So this is kind of related. What do you think is the most important ingredient to becoming a successful trader?
So is it going to sound crazy if I say discipline again?
No, that's fine.
Well, yeah, and it's not just about discipline, but it's also about distancing yourself a little bit from the money. You have to take that money and you have to say, this is for trading. The more you care, the more emotional you get. The more emotional you get, the less logical and less objective of decisions you're going to make with that money, the more easily it disappears.
Yeah. What about a favorite trading book or books?
Well, we have a whole bunch, but one that I go back to all the time, and which I actually just wrote a small review of for our website, was the Jack Schwager on futures technical analysis.
Yeah, that's a good one. And what's the best way for listeners to get in touch with you?
They can come to our 2chimps.com website. That's the number 2, CHIMPS.net website.
Yeah.
Where they can look at what we do. Our email addresses are there. All they have to do is write us, and we're glad to write them back.
Okay, and why the name 2 Chimps?
I think that came from an experiment that I was going to do many years ago, where several other traders and myself made a bet. I made the bet that a chimpanzee could trade better than they could, and they said it couldn't happen. So we took a bet of $10,000, which in those days was a lot of money. and we decided that I would get myself a chimpanzee and teach him how to trade, and the winner take all. But there was a problem, Andrew. I discovered a few things. First of all, in the United States, adult chimpanzees are not legal to import from Africa or anywhere else. So you had to get a used one. Only used ones were available in zoos, and they had been abused in the zoo so often they were very mean. Furthermore, the average adult male chimpanzee is 4 times stronger than the adult male. Can you imagine what would happen if he had a bad day in the market?
Yeah.
So I was foiled in that attempt, but that name and the idea still stuck. So Elliott and I decided we were the 2 chimps, and we could prove everyone that we could and they could because we were chimps.
The takeaway from the story, Andrew, actually, is that since Jake couldn't get a chimp, he had a son. And he started to teach him how to trade.
And Elliott works for bananas.
You don't have to walk around in the office in a monkey suit, do you, Elliott?
That's not a bad idea.
Yeah, only once in a while, but we keep it in the closet most of the time.
All right, cool. So is there anything else that either of you would like to mention before we wrap up today?
No, Andrew, we've enjoyed talking with you. It's been a lot of fun. And we wish you very, very, very good fortune in your venture. And any way we can help you, we'll be glad to do that.
Okay, great. Thanks. What about you, Elliott?
Nothing special. Just enjoyed the interview. Really good to reflect on our own methods and see them from a fresh perspective of having to explain them. So thanks for taking the time to talk to us.
Yeah, well, thanks a lot for joining us today. And I highly recommend everyone go over to the 2chimps.com website, have a little bit more of a look at Elliott and Jake's work. Thanks a lot for your time today, Jake and Elliott. All the best.
Thanks, Andrew. Cheers.
Cheers. Thanks, Jake and Elliott, for the chat this week. Here are 2 of my favourite insights. The first was rotational optimisation. This is a process where Jake and Elliott use to ensure they're not curve fitting to data. They'll start with their greatest inputs, what will trigger a long or a short, then move to profit target and then to stop. They'll rotate between the variables they're optimizing rather than trying to optimize them all at once. As Jake said, what most people want to do is optimize all variables at the same time and go through maybe 2 or 3 million tests. They will always find something that works if they do that, but it will not work going forward. Second point was on indicators. It was interesting to hear Jake and Elliott explain how a lot of traders don't understand the indicators they're using, and so they're being misused or misunderstood. I like the way Elliott put it. He said, a lot of the time at their base they have something, they're onto something. It just hasn't been refined to the point where it's something useful or has good predictive value. If you want to get more information about this episode, head over to the show notes, bettersystemtrader.com/19. We have links to additional content there if you'd like to know more about Jake and Elliott's work. Anyway, that's it for this session. Next week's episode, which will be episode 20, we have one of the biggest names in trading over the last 50 years. It's going to be huge, so look out for that one. I hope you enjoyed the chat with Jake and Elliott this week. Thanks for listening to Better System Trader, and I'll catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.